I'm David.
And I'm Melissa.
And we're your neighborhood realtors.
And we just wanted to give you a brief real estate market update heading into the new year. As you may have noticed, we've seen sort of a stagnant price in our area. We haven't seen incremental growth month after month like we have been for the last few years. So what does this mean? Have we peaked? And if we have, how close are we to the next peak? Let's dive in. In 2017, the average buyer qualified for $335,000 on a home loan. The average price in Fresno was $268,000. What does that mean? Buyers came in strong. They could come in at listing or above. Now this year, with the rise in interest rates, the average buyer only qualifies for about $300,000. The average home is $288,000. There's not as much buying power, and they're not going to be as aggressive because, again, it's going to be closer to their max budget. Now going into the next year, again, we're going to see more interest rate rises. The average buyer with the same income will only qualify for $270,000 for a home loan. And as we see, the average home price is still going to be closer to that $288,000. What does that mean? The same buyer only 2 years ago could qualify for $335,000, can barely qualify for the average sales price of a home in our area.
This chart here shows you the difference between a 10-year Treasury bill and a 2-year Treasury bill. Now, why is this important? The 10-year Treasury bill is a lead indicator of what our current interest rates are. Typically, a 30-year fixed rate is based off of what the Fed puts the value of this at. Now, this chart here is showing the difference between the 10 and the 2. Now, what's important about this is over the last 40 years, anytime the difference between a 10-year and a 2-year drops below zero, a recession hits our economy within the next 12 months. You'll notice the gray shaded in areas are the last 5 recessions since this has started to been tracked in the late 70s. So what does this mean for our real estate market? Currently, you'll notice that we are trending right towards that zero marker. Currently, there's a gap of 0.26, which is a very small gap. And that a balanced, strong market, we're at about 3% gap. 3% for a 2-year Treasury bill, 6% for the 10-year Treasury bill. That's why you often hear 6% interest rate on a 30-year fixed rate is the norm. So what does this mean? One of 2 outcomes is going to happen over the next 12 to 18 months in the real estate market. Option number 1 is interest rates are going to continue to keep growing, which will keep us away from that 0% difference between the 10 and the 2. Realistically, this is probably what's going to happen. Interest rates will climb above 6%, maybe even push 7% over the next 12 to 18 months. By doing so, purchasing power is going to drop. Now, option number 2 is interest rates flatten out and the 2 catch each other and we drop below the 0%, which will lead to a recession. Now, if a recession does hit in the next 12 to 18 months, our buyers' confidence will fall. So our 2 outcomes are purchasing power drops or buyers' confidence drops. Either way, we're going to see some form of drop in the market compared to what we've had over the last roughly 10 years. So what does it mean for you if you're thinking of selling in the near future? So the common trend has always been push the envelope, at least for the last 6 or 7 years. So if your home is worth $275,000, you have a goal of trying to get $280,000 out of it. Whether you start there, try to build people up and let the market push you up there. Today's market is the first time in a very long time not the case. If your home is worth $275,000 today, it is probably a smarter approach to start it at, say, $269,900, $270,000, right in that price. Because if you started high and worked your way, there's a real possibility that your $275,000 home today may not sell for $265,000 or even $260,000, because other smarter sellers are going to be undercutting and working it down.
So thanks for watching. Say bye, David.
Bye.
Say bye, Oatmeal.